Now we are going to discuss the break-even analysis from engineering style. So, in easy words, break-even is a point between a loss and a profit. It means when there is no loss, also there is no profit. Like the amount you have invested is equal the amount you have gained is the equal break even. So the advantages of break even are informed decision making. Obviously, if you know that at this point your original amount will be secured, so you will make more decision according to them. Then encouraging efficiency, financial forecasting, performance monitoring, risk assessment, and cost management. So all these things are the advantages and the pros of break even analysis. If you are able to do the break even analysis, either you are from the finance background or you are from engineering background or any other background, you will be able to do these. So when there is a profit, like revenue is greater than variable cost plus fixed cost, then obviously there will be a profit. And at break even point, revenue is equal to variable cost plus fixed cost. And when there is a loss, it means that revenue is less than variable cost plus fixed cost. So in my coming slide, I will tell you what is fixed cost and what is variable cost. But it is very common sense that obviously if your revenue is greater than your the expenses, then there is a profit. If the revenue is less, then there is a loss, and if both are equal, then this is a break even point. So, break even analysis in engineering style. Imagine you are building a machine or your product and you need to know how many machines you must sell before you recover all your setup cost. So, what is the break even point you will get? You want to this answer. So, fixed cost is like a cost that does not change with an increase or decrease in the number of goods or the services produced or sold. For example, you are doing a juice machine. Okay, now these are the examples like depreciation, amortization, insurance, rent paid, interest expense, property taxes, salaries, utility expenses, and advertising and promotional expense, equipment rental, legal expense. So these are the fixed costs. Like for example, if you are making anything, so the rent you have to pay, either you are making 100 pieces or 200 pieces. But the variable cost is the expense that changes in proportion to how much a company produces or sells, rising as production increases or failing as a production decrease. So, types of variable cost are the direct materials, direct labor, variable overhead, sales commission, shipping and freight, and lastly the direct expenses. So, these are the means if you are making again 100 pieces of a product, then you have a cost of 100 rupees suppose, and if you are making 200 pieces, then you have a cost of 200. So this will increase as number of product increases. So this is a graph. It means these are your fixed costs like your rent, utilities, and other one is your variable cost. Then if you add both of them, then you will gain your total cost. Like on the x-axis we have quantity and y-axis we have price. So, unit price formula is equal to, if you want to know the price of one piece or one unit, then total price divided by the total quantity. Then you will get the unit price. If you are running a business, so it is very important for you to know the price of each product. So, example, imagine you manufacture a robot arm that you sell for 500 each. That 500 is your price per unit, and it's the amount you charge a customer for one completed robot arm. So, this is a very easy example for you to understand that what is your price per unit. So, in an engineering analogy, think of a price per unit like the energy output per cycle. It's what you get back every time one unit, one cycle is completed and sold. So, obviously, engineers see things differently and different perspective. So, break even example is like the fixed setup is equal to 50,000 and the selling price per unit is 500. So, the variable cost per unit is 200. So, the break even will be, obviously it is a 50,000 divided by 500 minus 200 is equal to 160 units. So that means you need to sell at least 167 units just to cover your setup cost. And after that, every unit is profitable because of fixed costs. So the formula of break even is fixed cost divided by selling price per unit minus the variable cost. So by applying this formula, you will be able to get the break even point at which point your cost is equal to your expenses and profit, and you are at zero. So engineer's insight is like break even is like the critical point in a system. Before that you are losing energy, or you can say money, and after that the system becomes net positive. So I hope you understand. If you have any questions, you can comment me. Like, this is a center point between loss and a profit. At this point you have zero loss and zero profit.